Hi, welcome to Mark in a Minute. Hope you had a great Easter weekend. I had a great time. I went to a Nuggets game, haven't been there in years since Carmelo Anthony left. They won in overtime. Fantastic game. And on Sunday, wore my dogs out. We went on two walks, so 7 miles. The valuations of the market are more reasonable now. I think there's some really interesting stocks to buy at these levels. It's not cheap, but it's more reasonable. Trump is making huge geopolitical moves. I think there's more to come. I can't wait to tell you about what we're thinking about this. And we clearly took advantage of the decline. So lots of stocks that we purchased in our portfolios that were too highly valued came into our focus and got them purchased. Disclosures, please read this when you have a free moment. The market update. On the fundamental side, we do have some concerns, but nothing's really alarming us at this point. We think that the 10-year Treasury needs to hold 4.5%. Otherwise, we're probably going to drift lower, but it's currently 4.3, and we think we hit a bear market if rates go above 5%. And obviously, inflation is the focus of the markets right now. We're going to have some inflation numbers this week. Oil prices due to the war, above $100 a barrel. I think that's getting priced into the market at this point. So I think the market is starting to look through the high oil prices, knowing that this is a temporary problem. Probably shouldn't last more than another month, and oil will probably start to gravitate downward. Earnings are coming. Okay, what's important about this is we need to have a good outlook on 2027. We're not going to get that with these reports. It's too early in the year. But as investors become more confident, they can see out to 2027 and see a good outlook. That's when we're going to get the big move in the markets. Right now, the earnings just have to come in line, okay, not disappoint. If they disappoint, I think the stocks are going to get clocked, but in line with expectations. They don't have to beat and raise. I don't think that's necessary. I think just a reasonable report and the stocks will start to move higher. Valuations. Okay, look over here. So this is the 10-year forward PE of the S&P 500. 19 times is the average. So we're pretty much at the average of the last 10 years on the forward PE, forward 12-month PE of the markets. So we got as high as 23. We were, at that level as well back in 2020 because the earnings had disappeared during COVID. But we got as high as 23 not too long ago, and during the big decline during 2025, we had a 20% decline there. We pulled back all the way down to around 18 times for a short period of time and then bounced. And then I think we're doing the same thing. We're around 19 times. I think that's pretty much run its course. So when you think about this, if we have good visibility of 2025, a reasonable PE multiple of 19, you could have a really nice move up in the overall markets. So that's what we're looking out for. Technicals and sentiment. So here's the S&P 500. We've been in this sideways moving pattern for almost 7 months now. We clearly broke all the important moving averages, broke through the support level at 65.50 on the S&P 500, and then bounced very nicely back above that support level, which is now resistance, went right through it. So the downtrend line broke through it, broke through the resistance level back to about the 20-day. The 20 days below the 200-day. What we want to see is we have an upward sloping 200-day. That's good. We want to see the markets back above the 200-day moving average, which is about 66.48 on the S&P 500. The technicals are very important. However, when you're dealing with this one-dimensional view of what's impacting the overall markets, which is Iran at this point, in my opinion, the technicals aren't as helpful as they probably should be. So we're seeing some very short-term movements. We don't want to get caught in a market that it keeps going down. So the technicals are helpful in that manner. We think that by the time all this is resolved and the technical pattern really kicks in, a lot of the gains might be diminished at that point. The sentiment, okay, this is really interesting as well. The sentiment, 51% bears. So the sentiment is bearish, 33% bulls. So obviously much more in terms of bears versus bulls. That's a positive indicator. So when the sentiment is negative, it's good for the markets. We got to, this is a little over a year now, but a little over a year, we got to roughly 61% bears in the market. So we're 51, 61 was the high over the last, say, 13 months. Now, when I look at the volatility index, during that period where it got really bearish last year, it got to 45%, 45 on the volatility index. The volatility is basically a measure of fear. So the higher the volatility is, 45 is high, the more fearful the market is, which is also a positive indicator. We recently got over 30. We're about 24 right now. Back in that bear market during 2022, and we had negative GDP growth going through there. The Fed was raising interest rates. We were above 30, so nothing too shocking versus where we are now. So we're probably, the volatility index probably has factored into this, the Iran issues, much of the Iran issues. So versus the sentiment, the volatility, where the PE is now of the overall stock market, I feel reasonably good about having a fair amount of exposure to the equity markets. Okay, geopolitical risk. Trump's calling for $1.5 trillion in spending for defense. And he's right, okay? If we're asking NATO to spend 5%, why shouldn't we have to spend 5%? So 5% of a $30 trillion economy is $1.5 trillion. If we spend $1.5 trillion on all the technology stuff available, boy, we will just completely dominate globally. We're dominant now, but to put us versus anybody else in the world, like China, it's put such a big distance. I would agree with this type of spending. I think it's prudent. One of the risks to our economy has been losing the dollar. So we're a net debtor nation, right? We're spending much more than what we're taking in, and so we need the dollar. We need that reserve currency. And if we lose it, we're going to have problems. And this is not going to happen overnight. So Ray Dalio and Stanley Druckenmiller are all concerned about losing the dollar, that we should own gold. I don't think so. I think what's happening, I think Besant is really smart. And maybe this is just by accident. But you think about it. Venezuela, they were selling their oil to the Chinese, so they were getting back the Chinese currency, the yuan. Iran, the same way. So we were starting to lose the petrodollars, okay? It was starting to move off of the dollar into other currencies. I think this brings it back. So I think this is a really interesting move that's happening, maybe by accident, but I think in some manner, we are controlling the Venezuela oil. I think we're going to maybe control the Iranian oil as well, or insist that it's being traded in dollars. Given what's happened with NATO recently, and all of our because we built these Air Force bases around Europe, given that they refused us the ability to use them during the Iran war, I think that Trump goes after Greenland. I think he takes it some manner. Maybe does it with a smile on his face, but he takes it. So it'll be interesting when the head of NATO comes over here to the United States on Wednesday to see what comes out of that. But clearly, that's a strategic asset to defend ourselves. And that's probably on top of his list to take Greenland, again, with a smile on his face, to do it in a nice way. We think that Trump will start to charge for our troops to be in these foreign allies um, countries. It doesn't make sense for us to pay for having our troops there if we can't use the Air Force bases that we put in place. So I think that they're going to be moved around. Maybe obviously Greenland becomes more important, but it doesn't make sense for us to have troops in, say, Italy or Spain, where we weren't allowed to use the bases there to have troops in those countries. They can defend themselves. So I think the whole geopolitical framework is being rewritten by Trump. Maybe it's just falling into place as they go along, but I think it's completely being rewritten, and I think we're going to see a lot of changes around the globe. I think it's going to end up being very positive. They increase defense spending greatly and move our troops around. I think that's really interesting. Put the onus back on Europe and our other allies to help defend themselves, but have our backs covered completely. What we're currently doing. Okay, this is real simple. Oil above 100, I don't want to own energy anymore. Okay, you see every time. This is since 2000. Every time oil has gone above 100, what's happened to it? It's gone right back down. Maybe it's taken time, sometimes it takes some time for it to correct, but it comes right back down in price. So if we have this extended period of high oil prices, maybe it's a little too soon to sell, but we think that this is a temporary issue with Iran. It's going to come back down. So the range, the tight range, taking out the real extremes, has been $106 on the upside has been the high, and roughly $40 on the downside. Remember, we did have oil prices at one point, below zero. But if you sell at 100 and you buy these stocks below 100, or just do that with energy, and you don't have to do it very often to make a very significant amount of money, I think it's time to get out of your oil stocks. So we bought a lot of quality growth companies and also income stocks on this recent pullback. I think our portfolio looks beautiful. I think it's a work of art. I look at it, I'm like, I don't think I'd change anything except adding some icing on this cake, right? So we haven't fully deployed all of our money that we got defensive. We're out of our hedges. We own some income-oriented stocks in some of our growth portfolios to moderate the volatility at this point. But if we move from, say, 50, or maybe another portfolio that's 70% invested, we move from that 70% invested, step on the gas pedal a little bit as we break through that 200-day moving average. Could make a lot of money, and as we're focused on 2027. So what we've done was we were very defensive as we went into the year, had hedges in place, took our hedges off, got more invested in some really good companies that we haven't owned in a long time because they were too expensive. Now we're starting to get the benefit of that. The market's up nicely last week. Hopefully we can break through the moving averages and then start to see 2027 in our sights, and it being a good year. I think we can make we're going to make really good money on what we just purchased. Now, the income stocks are really interesting. We've got a lot of income stocks that are attractive. And this one stands out. The BDC stands out in a big way, okay? There's been two things that hit it. One is software, and we think software is a risk, but not now. Maybe 3 or 5 years from now, it'll be a risk. But the software stocks were a risk, but not their debt. So it takes forever for a software stock company to go bankrupt because they don't have any assets, right? So they stick around a long time. So many of the software companies that these BDCs own, they're going to be around for a while. And the BDCs portfolios, they turn over about 20 to 30% a year. So you can see in a couple years, they're completely out of the loans that they made. And most loans aren't over 5% anyway, 5 years anyway. So looking at the BDCs, the other issue was in the media in such a big way, was a lack of liquidity in the private BDCs. Well, duh. I mean, everybody knew that. There's no liquidity in those things. And so this became a big concern. Actually, we are looking at, though, is the junk bonds versus treasuries. That spread's been as low as 2.5. Now it's about 3.5. We think it's going to stop out around that 3.5. Maybe it goes to 4% spread over a treasury. That's about right. So they're starting to get some good value in the loans that are going to be made in the future. So the spreads on BDCs is actually going to get better. Now, if you look at the BDC ETF, the BIZD, okay, this owns a lot of different BDCs. You can see that in 2020, it got down to a lower level on an absolute basis. And we think that where it is currently, it discounts what's going on in the world. So we think it's an attractive valuation here versus what happened during COVID. You know, they thought, well, no one's ever going to pay a loan back when COVID was around. And it got to an extreme. We're not far from that level. We're we're at about a 15% discount to NAV for these BDCs. There's a couple of these that stick out. You know, we probably have about 6 that we really like. One we've talked about, OTF, that they have a position in SpaceX. It's about 4% of the assets. We estimate it's about 4% of the assets. So we think they're going to get a bump when SpaceX goes public. It's not a big bump. It'll be a bump. And they own a lot of private equity as well. So as the stocks, the market starts to improve, more IPOs coming, OTF will benefit in a nice way. The other one is Hercules, HTGC. I've never owned this BDC because it's always been too expensive. It's got a 12.5% yield. I think this is probably the primo management team in the industry. It's all internally managed, so it has a higher value versus its net assets because it's internally managed. So they save that money. So there's some value of having that internally managed versus externally managed. So we like that one as well. HTGC, over 12% yield. You know, we haven't ever owned it. I like it a lot. So just to summarize, we think the market's starting to come back. We're looking at that 200-day. We bought some great stocks in this pullback. We think as we go through the year, if 2027 looks good, okay, we'll know that kind of in the middle of the year, we're going to see another 10+% rally to the overall markets. So buying things now that are attractively valued, that are growth companies, high quality, we don't see a lot of risk to it at this point with the valuations being reasonably priced. So if you have any questions, you know, come to my website, Patrick Adams CFA. Ping me from there, ping me from the video. Come to where I work. I'm the CEO of PVG Asset Management. You can see some of our strategies there, and likely you'll find some really interesting strategies that probably fit your overall investment views. So take care.